Good afternoon, ladies and gentlemen. On behalf of the management of Dabur India Limited, I welcome you to this conference call pertaining to the results for the quarter and 9 months ended 31st December 2018. I have here with me Mr. Sunil Duggal, CEO, Dabur India Limited, Mr. Mohit Malhotra, CEO, India Business, and CEO designate for Dabur India, Mr. Lalit Malik, Chief Financial Officer, Mr. Ashok Jain, EVP Finance and Company Secretary, and Mr. Ankush Jain, Head Financial Planning and Analysis. We will start with an address by Mr. Duggal, followed by a Q&A session. I now hand over to Mr. Duggal. Thank you.
Thank you, Gagan, and good afternoon, ladies and gentlemen. Welcome to Dabur India Limited conference call pertaining to results for the quarter and 9 months ending 31st December 2018. Domestic FMCG business recorded growth of 15.2% on the back of volume growth of 12.4%. In the base quarter, we grew volumes and revenues by 13% and 17.7% respectively. Growth was driven by double-digit growth across all the three verticals, led by investment in brand building and distribution expansion. Consolidated revenues from operations grew at 11.8% in quarter 3. HPC vertical posted growth of 16.3%, led by a strong performance in hair and skin care. Hair oils registered a strong growth of 23.6%. Volume market share in hair oils moved up by 50 basis points vis-a-vis the same quarter last year. Shampoos posted a robust performance, growing by 25.2%. This was despite high growth of 56.1% in the base quarter. Skincare registered growth of 19.3%, driven by double-digit growth in Gulabari and good performance of the bleach portfolio. Oral care category grew by 10% with 11% growth in toothpaste. Red franchise continued to perform well, driven by increasing penetration, aggressive marketing, and visibility initiatives. Babool had a muted performance due to high competitive intensity at economy price points. Despite that, our market share in toothpaste category continued to see an uptick. Home care grew by 8.9% this quarter, backed by strong performance of Sanifresh. Odonil and Odomos recorded subdued performance because of low institution orders in the base. Healthcare vertical performed very well with growth of 15.9%. Health supplements grew by 13.8%, led by double-digit growth in both Chyawanprash and honey. Digestives recorded growth of 22.5%, driven by continued strong performance of the Hajmola tablets and Pudin Hara. New variants, focused marketing initiatives, and distribution expansion contributed to driving this growth. Strong winter season also helped in generating good demand for the winter-centric products. OTC category grew by 17.7% because of good growth in Lal Tel, Honitus, and Shilajit. Ethicals business picked up pace and delivered growth of 17.4%. Foods recorded growth of 11.1%, which was slightly lower than other verticals, primarily due to exceptionally cold weather. Profitability in foods continued to see improvement because of network optimization and lower input costs. Media spends, tactical consumer promotions, modern trade focus, e-commerce, and new products continue to drive the business. Driven by these initiatives, our market share in the JNN category increased to 56%, an increase of over 300 basis points over the same quarter last year. International business reported growth of 3.4% during the quarter. Egypt market declined by 10% on constant currency basis because of hyperinflation and liquidity issues. SAARC grew by 11% on the back of strong growth in Pakistan and Bangladesh. Hobby had a strong quarter, growing by 31% in constant currency terms. However, the currency devaluation impacted its translation into INR. GCC markets reported a soft performance due to consumption pressure and sharp decline in categories. Namaste business registered double-digit growth in SSA and North America, but was brought down by EU and the Middle East. Operating margins in international business declined by around 250 basis points because of increased trade schemes, adverse material inflation, and adverse currency movements. Standalone operating profits increased by 18%, and operating margin increased by 60 basis points to reach 22%. While media spends this quarter were lower, the overall marketing spends, including promotional expenditure, increased by 20% in consolidated and 9% in standalone. Consolidated operating profits posted growth of 10.4%, while with operating margins steady at 20.3%. Tax increased by 17.6% in standalone and 10.2% in consolidated. Today also happens to be the day when the interim budget has been announced. The impact of today's budget will be positive on consumption trends in India. The package announced for supplementing farmers' income, increase in Manrega to 60,000 crores, tax cuts for the middle class taxpayers, and other such measures would surely increase the disposable in the hands of the consumer and lead to increased consumption of staples in the next few years. Looking at the longer-term trends, 172 million lower and middle class households in India, which earn an income of less than 10,000 rupees per month, are likely to see steady growth in their income over the next many years. This, in my view, is a strong lever for driving sustained FMCG growth going forward. As you would know, the succession planning which we had embarked upon a couple of years ago has now concluded, with Mohit succeeding me as the next CEO of Dabur with effect from 1st April. The entire succession process has been in progress for over 3 years and has been meticulously planned. It has involved extensive internal preparation and external intervention to ensure a seamless transition. Mohit is an outstanding professional and has done a commendable job in all his assignments and the 25 years that he has spent in Dabur. I'm happy that he is going to take over this job, which I've been doing for the last many years, and I assure you that he is extremely capable of handling it. We wish him all the best in his new assignment. Lastly, on a personal note, I wish to thank the investor community for their unwavering support for the last 17 years, which has enabled our market cap to increase from 1,600 crores in 2002 to over 80,000 crores today, a 50-fold increase. I have always enjoyed our interactions over 61 consecutive quarterly conference calls and innumerable meetings in India and all over the world. This has been both energizing and enriching, and I have gained immeasurably from these interactions. I look forward to remaining in touch. With this, I now open the Q&A and invite your questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir. This is Percy here. Sir, congrats on a very good set of numbers. And in domestic, quite heartening to see price growth coming back. I think this quarter, your price growth is nearly 3%. I'm just taking the difference between volume and value. And that is much higher. Yeah, 2.8, which is much higher than what we've seen in the previous couple of quarters. So despite this higher price growth, we are seeing compression in gross margin in the standalone business. We've seen about 130 bips in Concall, 230 bips. So just wanted to understand why both for standalone and for Concall, if you could, or rather standalone and international, if you could reply separately. What are the drivers? I mean, in spite of consumer promotions, your price increase has accelerated. So then it has to be inflationary pressures only. Is my understanding correct?
To some extent, yes, because we did buy into slightly higher price raw material in the first and second quarters. Inflation cooled off dramatically in the third, but then we were still consuming the earlier purchased materials. I do see the gross margins now coming back to the earlier levels, perhaps as quickly as the fourth quarter. So there's nothing structural in the domestic business. There's been no huge levels of promotion, even though our consumer promotions have gone up considerably, but it's not that large. In international, it's a little bit more structural because of higher consumer and trade promotions. We've taken up that whole number significantly because of the headwinds which consumption has in those parts. And there you see lower gross margins emerging, both on this account as well as on account of the currency devaluation. Now we'll have to rebuild those, and hopefully with currency stabilizing, we should be able to do that. And also if the consumption piece revitalizes, then again the margin should come back. So I'm very optimistic about the domestic margin profile. I think it should emerge quite strong over the next few quarters. International, we'll have to still wait and watch due to the externalities.
Right, sir. And just wanted to understand what's happening on the volume growth front. I mean, this quarter you've hit the ball completely out of the park. Q2 was around a 8% volume growth. This time we've accelerated to beyond 12, which is our best in several quarters. So just wanted to understand the drivers behind the same. Do you think there is any change in the macro which is driving this, or is it mainly some company-specific measures? And if it's the latter, do you think this kind of volume growth is sustainable going ahead?
I don't think you should look at volume growth in a quarter in isolation. There is a big impact of base. And like even last quarter when we did a little more than 8 and people said that, this is well below our expectations. I said you should, moderate expectations in line of the base. And we had a high base in quarter 3. It's comparatively soft because of the shift in seasons in quarter 2 and a little bit softer in quarter 3. So if you again normalize these two numbers, you get to around, 10-11%?
Yeah.
So that's what I've been maintaining, that we are in this kind of trajectory as of now. And going forward, we don't know. It could accelerate, could decelerate, could remain pretty much the same. But I think with the measures which we already saw this morning and also perhaps going forward, we'll see more of them. The consumption space does seem to be pretty decently poised to have reasonably robust volume growth. So again, normalize it. This year we'll be doing double digits as I've always maintained, but it'll be lumpy, and one has to live with that fact.
Right. And do you think this double digit can continue into FY20 as well, because you have significantly high base in some of the quarters in FY19?
Yeah, it'll have to be fueled by significant increases in disposable incomes, because on a normal base, which we have in 18-19, getting to double digits is not a walk in the park. So we have to have some tailwinds behind us. So there has to be improvement in the whole consumption space. Disposable incomes have to inch up, or not just inch up, but go up significantly. And then I think double digits will be visible. In the event of that not happening, then it's going to be perhaps again back to the high single-digit trajectory. I don't see it coming down significantly below that. But this is the base case and the bull case scenario. Base case is that we continue that 8 to 10% growth. The bull case is we get into double digits on the back of stimulus and disposable income increases, and we don't know where the truth lies at this point in time.
Right, sir. And finally, if I can just ask for a few comments on some particular categories. Firstly, hair oils growth has been very, very strong at around 24-25%. So what exactly is happening there? Are there any pipeline issues or anything, or is this sort of representative of the end consumer demand you've seen this quarter? That's one. And secondly, on juices, it has been weak. What is the reason for that? And thirdly, on toothpaste, is it mainly just bubble-led problems, or are you seeing a slowdown even in Red?
No, Red continues, accelerating at a decent pace. Of course, this 20% growth will not continue forever, but while they are there, we are quite happy to live with it. But hair oils, which to the earlier part, is something which has surprised us positively. 20% growth in hair oils has never been easy, and we've been doing it now for the last couple of quarters. Close to 20%, of course. It's really on the back of market share gains rather than any huge consumption improvement, the way I look at it. I mean, it's a little bit of both, but the market share gains, even though maybe only 50 basis points optically, I think have led to a pretty significant improvement in our overall growth. And this is both in Amla hair oil as well as in the coconut space, as well as the lower-priced perfumed hair oils. It's everywhere. All the hair oil brands are fired. Almond hair oil, for example, has done extraordinarily well. And we have, the work over the last few years in terms of building distribution infrastructure, expanding the brand franchise beyond Amla hair oil and Vatika are now paying very rich dividends. Anmol is a 100 crore plus brand. Your almond is doing extremely well. The Anmol Jasmine, we did again a great sales last few quarters. Sarso Amla is now 100 crore plus brand. So all these are now kicking in.
Right, and foods?
Foods a little bit soft. It is underperformed to some extent. The reason is two. I think the main one is a very cold winter in the north, which is around 2/3 of our consumption in the northern zone. And that does lead to some depression in consumption. And also, coupled with that is the massively increased competitive intensity, people just throwing money in terms of trade promotions, etc., etc. And it's a combination of both. There's nothing wrong with the franchise because the market shares have grown tremendously. It's just that the consumption of beverages in particular in North India has slowed down considerably in the third quarter. And let's see now how fourth quarter pans out. The winter continues to remain very severe in the north. So we may not see that kind of growth even in the fourth quarter unless, March turns out to be very hot. But there's nothing structurally wrong. Our franchise is extremely strong, distribution, supply chain, absolutely no issues. And now the new products also beginning to kick in, the masala range, for example. And so I do expect the next year to be a decent one for foods.
Okay, sir. That's all from me. Thanks and all the best.
Thank you.
Thank you very much. The next question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Hi, sir. Congrats. My first question is on the very high promotional intensity in the beverages and the toothpaste business. So, how is the profit pool for the industry? Would it not be down significantly versus, say, 2 years back in both these segments?
Unfortunately, the COGS are pretty much on our side. So whether it's beverages, or whether it's oral care or even hair care, etc., HPC has benefited a lot from these material cost tailwinds, which has kept the margin profile at a pretty decent level. If I'm not mistaken, the foods margins have actually gone up considerably. So no issues in terms of margins, but yes, if we have to further up the whole 0.6% in foods, which is pretty significant, but keep in mind that this has been without us retaliating in full measure, which we probably will start doing now. So the margins may trend down, but not significantly. So we may not see any growth of margins, let's say, in the fourth quarter in foods. We might see some decrease, but it'll be for a noble cause of protecting market share and try to increase the sales volumes.
And what about toothpaste? Because HUL has become very aggressive on pricing and Patanjali is very aggressive on the wholesale promotion. So are these two things a big worry from longer term perspective or more of a tactical?
I think the attack is impacting Babool and not Red. And we have to now make sure that the Babool franchise is reinvented and re-energized and get growth from there, because that's really the only drag here. But yes, the consumption intensity is high. We don't know how long it'll last, but I think our fortresses are largely intact. And we do have some very clear plans in terms of revitalization and reinvigoration of Babool, which you will see perhaps this quarter itself. And I think that would be significant in improving the fortunes. Now, Babool, which is now in negative territory, it goes into even break-even or slightly positive. It will be a big uplift for the oral care portfolio as a whole, and I'm pretty sure we'll be able to do that.
So where is the Babool customer going? Because many quarters, Babool has been seeing very challenging numbers. Your overall growth is still decent. 11% in toothpaste is still decent number. So is some flow of Babool happening to Red also?
Well, a little bit of that happens, but perhaps now with the 10 rupee franchise and the 10 rupee universe expanding to beyond Babool and Sabaka, which were the only two incumbents, there's a lot of choice available for the 10 rupee consumer. He can buy Ved Shakti, he can buy Active Salt, he can buy Patanjali. So that obviously does have, and the gels are now significantly at 10 rupees, almost embedded at 10 rupees, Close Up and Max Fresh. So there's a big choice before him. Therefore, some of them do opt or at least experiment with other brands. And we just have to make sure that the stickiness of Babool improves, because we do believe that these 10 rupee price points are going to stay here for a while.
So could you talk about your smaller hair oil brands? Almond, I'm seeing a 100 ml plus a 50 ml promotion on top of that. And Sarson Amla, the 17th brand to hit 100 crores. So the Marico has also been aggressive in Sarson. So any impact of that? And in Almond, what is the market share gain?
See, the competitive Sarson products have not done well, so that doesn't bother us. But we are, in hair oils, we are matching competition by rupee for rupee in terms of promotions. And that's why the whole promotions space has increased quite a bit in the domestic business. So the gains in market share are there, and we are holding on to our margins because petroleum prices are friendly, which is the main input cost. That's the reason why we are able to do well in hair oils and not have our margins also eroded there.
Market share in Almond is not very significant. As we see it, it's still a small brand. So as a percentage of the Almond category, it's still around 5%.
But we are growing Almond at around 40% or so. So if it's fueled by promotion, I think that's something which we live with, because we have to build the brand up to a certain scale. And to do that, it does require promotional intensity, because we are not at a discount to the market leader. Unlike the other perfumed hair oil brands, which our competitors have put at a sharp discount to us, we are parity with the market leader. So if you want to gain franchise at his cost, we may have to be a little bit more aggressive than him in promotion. But having said that, I think the incumbent is also very aggressive in promotion. It's not that we are the only one.
That's right.
Yeah.
So next question is EBITDA margins for the domestic business is fine, but you have managed that through the A&P cut. Now, Patanjali's ad spends first 9 months is down sharply in most categories significantly. Is that the reason, or you have cut down on ad spends because there is a gross margin pressure, or you want to phase it out? Which is the real reason? So is the structurally the industry lower on ad spends because Patanjali has cut down significantly?
Well, the A line is visible to everybody, and in the case of domestic business, it's up by around 3%.
So I think only media is 2.8%.
Sorry, total is 8.9%. Yeah, exactly. That's what I'm saying. The media part, the A part, is up by around 3%. The A and P, and you don't see the P, is up by around 9%, right? So it's not that we are cutting back very dramatically in terms of A, but yes, there is moderation in spend there because we are spending much less than what our top line is generating. So the P part is growing well ahead. And this is largely to counter these disruptive areas in beverages, in hair oils, toothpaste, etc., etc. We have no recourse because that's the only weapon which we have. So while we don't like the idea of having A&P reductions, but it's still something which is not a bad number. And if you go by many other companies, they've seen sharp decreases in their A&P, which we haven't resorted to. And going forward, the intent is to build up the A part, and hopefully we'll be able to do it if some of the headwinds ease and if the consumption improves.
Sir, at the start of the year, you had identified that every year you'll take smaller brands to the bigger level. So this year, first 9 months, what has been the performance? Which brands you had put more effort?
Honitus, Shilajit are the two standout performers. We've done also well in Pudin Hara, moderately well in Lal Tel. So I think it's been overall a very positive reaction to our higher levels of investment, especially for Honitus and Shilajit, and Pudina has done extremely well. We also upped the whole promotion and the advertising expenditure on Hajmola, which has done spectacularly well so far. So I think the team is in place. We did have issues with regard to leadership in the healthcare team. That's been plugged now. We have a great set of people, and now once we have that, then we are willing to sign the check in terms of advertising and promotion. So it's going exactly according to plan. We'll up the whole ante in this space, maybe add a couple of new brands in the next financial year, and our plan remains completely unchanged. There was perhaps some issues when demonetization and GST happened. It impacted the space quite a bit, but now things are back on track.
And the last question, your honey has grown very strongly at 19, almost 20%. Now I see the premium of Dabur and honey on Patanjali coming back significantly again. And then we have a new competition from Rasna, which is selling 35% cheaper than even Patanjali at 99 rupee in the e-commerce at least for a 500 grams. So one is, how are you able to manage good growth in spite of now premium coming back? And any risk from Rasna from a medium longer term perspective?
See, we always enjoyed a 30-40% premium over our lower price competitors, and we were able to sustain and grow market share despite that. The only disruptive force which came into play was Ramdev, which came on the back of certain assurances and promises. But, the consumer now is back to very happy to pay us a 30-40% premium. And I don't think any other, company coming in will be able to disrupt this premium which we enjoy. So we are taking down promotions a little bit gradually. And again, the whole idea is not to have huge premiums over our competitors, but a 30-40% premium is something which I think is structural, works for the brand, and something which we should not discard. But at the same time, we have to ensure the highest possible quality of honey, and that's something which we have never compromised on.
Okay, sir. That's all from my side. Thanks a lot.
Thanks.
Thank you very much. The next question is from the line of Prakash Kapadia from Anived PMS. Please go ahead.
Yeah, thanks for taking my question, and congrats on a wonderful journey, Sunil. Always been a pleasure to interact with you and hear your views about the industry and the way you've grown Dabur. Real congrats for that.
Thank you very much. Appreciate it.
Right. I had two questions. If I look at, the current domestic mix of 70 to 73%, on a medium-term basis, do we expect this mix on international and domestic to be around this level? And in domestic, of the three broader categories, which would be the fastest growing, and what is the focus areas in the medium term for us?
I think we're now, this quarter we were at 25% international, 75% domestic. It seems to have kind of leveled off at this point, but at least for the next 2-3 quarters, I do expect the domestic business to grow higher than international. Maybe not significantly so, but definitely because we still haven't lapped the whole currency issues which began in the second quarter of last year. So once a rebalancing happens, I think the ratio will stabilize at around 75-25. And in terms of the best performing categories, I do expect next year the OTC part to be the best performing. It may not be the largest category which we have, but I think it certainly should perform above most of others.
Okay, most of the others. Okay, and the entire new product pipeline will help us there, or is it just the older products with the...
No. Next year you will see significantly higher number of new products. I think we've now over that issue, the disruptive issues, and we kind of rebalanced from that. We've rebuilt our revenue line, we've rebuilt margins. Now we would like to invest significant amounts in new products, and you've seen a little bit of that happening, but you'll see far more happening next year. So new products would be a big driver of growth. Perhaps even at the cost of some profitability, but that's a good trade-off if the new products succeed.
Understood. I'll come back if I have more questions. Thank you. All the best.
Thank you. Next question is from the line of Vivek Maheshwari from CLSA. Please go ahead.
Hi, good evening. My first question is on the rural market, sir. What is the trend that you have seen in the quarter gone by? Obviously, lots can change after the budget and what government is intending to do. But what has been the experience for the previous quarter?
Well, if you take, there is a 4% delta between rural and urban. Having said that, if you add back modern trade to urban, then the delta kind of reduces to 1% or thereabouts. But this does not factor a certain amount of consumption with its origin in urban, but actually going to rural, which is hard to factor. So I would estimate, it's almost impossible to give an absolutely correct number, but rural outgrowing urban by around 2%. Now, going forward, I think that would continue, perhaps even expand, because the rural stimulus is likely to be higher than urban. We've seen a little bit of sample of that this morning when you are having the whole pension schemes and as well as the doles of 6,000 rupees, which will definitely improve rural consumption. Urban is likely to be steady, but the whole growth will come significantly from rural.
Okay. Second, on the promotion bit, I'm not very clear. So if your revenue growth in domestic is, let's say, just under 15, and if your volume growth is 12.5, that the delta is 2.5 percentage points of pricing. But, since your promotion... Sorry?
Pricing and mix. Let me just walk you through the detail. But yeah, please continue. Finish your question.
Sure. So pricing and mix. My only question is, if the promotion intensity was higher, does that mean the pricing growth was higher than 2.5% then?
No, I think, in fact, the price growth is around 2.7, the mix impact is around 0.1. So overall, what you see, the gap between volume and value is around 2.8%. But I think on the promotional side, what you don't see is the consumer and trade promotion, which is reduced from the sales to arrive at the revenue, which is what earlier what Mr. Dugal suggested, that though A&P reflects 2.8% growth, effectively, if we add CPs and TPs, it is around 9% growth. So these are the two factors that you get to see when you add up at the gross level.
I understand that part. So which means the revenue growth is deflated to the extent of promotion, which means the pricing impact is deflated. So does that mean so let's put it this way, 2.4% or 2.67% pricing on a like-for-like basis, adjusting for promotion, how much that would be at, let's say, MRP level?
I think at an MRP level, if we were to see, it should be within the range of around 3.5 to 3.6%.
So as you reverse the promotion intensity, that is what is going to benefit you in terms of both the growth and will also obviously add to margins.
That's right. And plus, I think we'll also have to see how do we rebalance the total A&P. So if we reduce TP, maybe we'll invest a little more into media. But that we'll have to see how that will go.
I think we almost certainly will. So I don't see that being because our A&P, our A part is actually a little bit below what we would like to have. And, the marketing team is always wanting some more money. So we'll be happy to give it to them if the promotional intensity is reduced or if the inflation tailwinds accelerate.
Sure. And lastly, on international business, Mr. Dugal, what is your medium-term aspiration from this business? I mean, in terms of growth, because it has been fairly bumpy, right? And not just for you, but for, for your peers as well. But how do you think about, the international business as a basket?
I think the medium to long term is the prospects are very good. We are very enthusiastic about the long-term prospects. There will be always volatility, and I think let's say 3-4 years ago, this business was driving growth in a very significant manner. Then it fell off significantly. We are getting our momentum back. It'll take another quarter or two, so I do see headwinds happening in this quarter and next quarter till we rebalance the currency devaluations. But I think from the second half of next year, perhaps as early as the second quarter of next year, we should see good growth coming back. This is with a disclaimer that the currency should remain reasonably stable, and the economic situation should not go completely downhill, which some people do speculate will happen in the Gulf. Now, if these two events don't happen, I think the businesses are very well poised. We have seen sustained gain in share. The teams are intact. Many of our constant currency growths in, let's say, markets like Turkey, it's all are excellent. Pakistan, Turkey, many others, Bangladesh. So I'm not at all worried about the long-term prospects of this business. Yes, there will be turbulence, and we have to live with that.
Got it. Thank you, and I also wish you all the best as you start new journey in your life, and I also wish Mohit all the very best for the new role. Thank you.
Thank you. Yeah.
Mr. Nilesha, you may proceed with your question. Your line has been unmuted.
Hi, thanks. Just a quick question from me. In terms of the international business for Namaste, you highlighted that Sub-Saharan Africa and the US has done very well, but there are some issues in the EU and Asia, and some other parts of the world. So where is the problem actually? If it's Sub-Saharan Africa and US are okay, then where is the issue?
Yeah, I think you're right that that's a smaller part of the business, but why is it being such a drag? The reason is that we practically did no sales in the third quarter in EU because of some issues with regard to pricing. The distributors there, it's a distribution-led business, demanded a certain price, and we kind of drew the line that we will not give you that price. So there was practically no sale happening there. Now, I think that's a necessary issue which we have to face, that we cannot be compromising on our pricing. And if we are firm on that, we may have some short-term losses, but long-term we'll gain. We did exactly that a few years ago in Africa when we drew the line again on pricing, and did suffer quite a bit for a couple of quarters, but the business then rebalanced very strongly. And we also did the same in North America. So you have to take this bitter medicine, and this is the last area where this medicine has to be administered. The pricing is largely corrected in North America and SSA, which are the two big consumption segments, and you're seeing good growth happening, double-digit growth happening from there. I think EU will correct, maybe not this quarter, but next. It does take a couple of quarters for somebody to blink, and, we certainly don't intend to be the first one to do it.
Got it, clear. And, the only other problem really in the entire pie is GCC. There are no big currency issues out there, but it's more of a macro problem in that region. So do you see that also correcting itself over the course of the next 2 quarters or so?
Perhaps it'll take 2 quarters, this one and the next. Now, having said that, in the GCC itself, our secondary growths are very good. They are at high single digits, which is not a bad situation considering that the overall category growths are declining. So our market share is improving. Our business on the ground is doing fine. We are concentrating a lot upon shampoos and toothpaste where we have comparatively low shares. But so the upsides are almost unlimited. And I think we've got our strategies right in terms of focusing on the core, which is hair and oral care, and perhaps disengaging a little bit from the skincare business. So I don't see long-term issues, but then having said that, if the economic downslide continues or accelerates, and I'm no expert on how things will pan out, then the problems will continue. But otherwise, we do see light at the end of the tunnel from the second quarter of next fiscal. And the rebalancing could be quite sharp. The growth in business could be quite dramatic. But there has to be macros which don't go against us.
Okay, got that. And the final question...
Just to complete that. Now, Turkey, for example, had a massive devaluation in August last year. And now the currency is steady, actually strengthening a little bit. If this trajectory is maintained, then Turkey will emerge as one of our big growth drivers because we are growing the business at around 30-35%. All of which we lose in translation. But if the translations are not there, then that itself will provide us with a big impetus. Namaste, I think, will continue to now deliver reasonably high growth once the EU issues have been sorted out. And SAARC and many other geographies remain, very constant. I think the big concern is GCC and how will the economies behave. There's no other issue which we are facing there.
Right. So then when I extrapolate this to margins too, your acquired businesses were operating at least last year with margins which were like in the mid to high single digits. So does this mean that there could be over a course of, let's say, the next 2 years, there could be a 500 to 800 basis points delta even on the margins front for the acquired businesses?
If the currency remains stable in Turkey, yes, we would see that kind of increase. And if the top line in Namaste, which is a high margin business, continues this trajectory, we would see that kind of growth happening, 50 to 100 bits improvement in the EBITDAs. But there has to be these tailwinds behind us.
Okay, got that. And finally, coming on to the NPD pipeline that you spoke about accelerating next year, will this entail getting products from your international portfolio into India? Will that be the primary focus or completely?
No, that will be that will be an interesting but comparatively small part. We intend to seed many of these products through e-com. And also we have to now see how the e-com policy evolves and what impact does it have on our business. That's another narrative. But broadly, the products will be incubated through e-com, and if they show life, then they will go to modern retail and then to the general retail, if at all. So this is a very different way we can do it. These products are highly premium and are affordable only by the upper crust of society. So it's not something which we can do on a mass scale. But incomes are rising, as and when these products begin to show some traction, then we can accelerate the growth through wider distribution.
So then could you give us one example of what the NPD pipeline for your mass market portfolio could look like next year? I mean, you spoke about a toothpaste brand or toothpaste product being launched sometime. Would that be one such example of what you intend to do next year?
Yes, one such example is that. Then broaden the whole ethnic flavor range of beverages, perhaps get into other beverage segments which we are not present in, and that's been under discussion. But the innovation will continue everywhere, whether it's in home care or whether it's in, hair care, etc. They will be everywhere, and it's not that all of them will go to market. We'll choose the best ones and aggressively push them. And then we'll also have to see what kind of resourcing do we have. Now, if the inflation continues to be benign and the category growths trend up, then there'll be enough money on the table to fund many of these initiatives. Otherwise, we may be constrained to do comparatively fewer, but certainly more than what you've seen in the last 2-3 years.
Okay. And last question, at the start of the year, you had said focused on market share, and hence the margins could be flat on a YOY basis for fiscal 19, and that's probably where you're going to end at. So any views going into fiscal 20? Would there be an expansion now that you've kind of rebalanced the whole thing?
Yeah, I think there would be some leverage. As I mentioned earlier, that in most of the lines in our P&L, you would see deleverage in the current fiscal, whether it was IOH or whether it was S&M, etc., because of big investments. Now, these would be in the base. So I think the leverage will kick in next year and right from the first quarter of next year in many such of these operating areas. And I see a fairly benign outlook on COGS. Now the key thing is, would we let all this flow into the bottom line, or will some of this be sucked up in A&P? And I don't have the answer to that. But the desired route would be, as Lalit just said, is to take some money out of the promotions and put them into advertising and have the aggregate spend at current levels. But that may not be possible if the competitive intensity remains the way what we've seen in the last few quarters.
Okay, thank you very much, Mr. Dugar. All the best.
Thank you.
Thank you. Next question is from the line of Mehul Desai from IDFC Securities. Please go ahead.
Yeah, good evening. This is Harith here from IDFC. Just two questions. Firstly, on the international business. So just wanted to get a sense of how large is the GCC portion for you now in the overall mix on the international side?
Around 30%.
30% of international is GCC?
Okay. Of international, yes. 30 to 35.
Would it also be fair to assume that the margins in this business would be slightly ahead of overall international margins?
Significantly ahead.
Significantly ahead. Okay. And this second question, sir, was on the hair oils piece. So obviously this quarter there's been a very strong growth in hair oils, and you've mentioned that it's been across the board. And if you could just give a sense of, where this growth is coming from and where the share gains have been from, really, if you could just give a little bit more light on that.
Right. The share gain essentially has been on the back of the flanker brands that we introduced, the economy brands. So Sarson Amla has actually gained share, Brahmi Amla has gained share. To Mr. Duggal's point, I think almond hair oil has done very well. And Dabur Amla hair oil is also back on a growth path now, as we see. So our volume market shares have actually gone up by 80 bips if you compare it on a YOY basis.
Okay. Got it. The third question was really on this staff cost. If you could just give a sense of, how much more accelerated in FY20 would be the costs, on account of the ESOP impact, and how much would it have been this year?
Sure. I think as far as ESOP cost is concerned, next year it will be in line or maybe slightly lower, but it will maintain, so there won't be any further increase that will happen compared to this year. So this year has been a year of the first year of vision. Therefore, the cost is on account of the current market price, and therefore we see the increased cost in the employee cost and a percentage of growth that we have seen. But going forward, it will equalize because the base will remain the same, but at the same time, it will be either comparable or it will be slightly lower in view of amortization.
So that will happen from Q1 of next year itself?
That's right.
Yeah, Q1 you would see some leverage emanating out of these salary expenses, which include ESOPs.
Got it. So that's it from me, and once again, wish you all the best.
Thank you.
Thank you very much. Next question is from the line of Amit Purohit from CIMB. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations. So from the growth, again, just want to understand this quarter growth you indicated driven by distribution and new launches, and how much was the rice strategy also playing out, or the benefits of that would see in the ensuing quarters?
Right. So rice has actually kicked in. So I think we started the journey of rice way back in the first quarter. So I think we've done a lot of analytical piece on rice as to how much, which state is actually contributing to the business, what is the level of profitability, etc. We've done a small test market of rice in the Northeast, and I think in the last call also I talked about it. So the growth in the Northeast markets is at the rate of around 34%. We put up new infrastructure in place. So we've done a test pilot very, very successfully. As we speak, next year going forward, we'll be now extending rice to other states also. So therefore, a lot of innovation that Mr. Duggal talked about will be taking germ from the rice initiative also going forward. Yeah.
Okay. Any specific categories that you think you can call out, or it will be just because it will be region specific, so then hence it's difficult to call out any couple
No,
of
it's across the board. So rice is across states, across geographies, and it's portfolio agnostic. So across portfolio, whether it's HPC space or HC space or food space, so there will be innovations which are pertaining to rice. So when it, like its juices, if there are any flavors to be introduced, there could be very regional specific flavors that we may introduce going forward. If it's a hair oil, somewhere it's a coconut oil market, somewhere it's a perfumed oil market. Or so it's very region specific, but across portfolios.
Okay. Thanks a lot. Thank you. All the best.
Thank you. Thank you.
Thank you very much. Before we take the next question, we would like to remind our participants that you may enter star and 1 to ask a question.
Nobody in the queue.
Next question is on the line of Arnav Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Congrats on a great quarter. First question was on hair oils, where you've seen, which has probably driven the highest growth this quarter. Now, a few years back, you had taken a view that possibly this is not a growth category, so you would not want to invest in it. But since last year, you've put in some investments, tactical measures. Now, as we go into the next 2-3 years, do we see you kind of seeing this as a growth category, actually putting in a fair share of investments, advertising, new products? Or is it just very difficult to sustain even a mid-teens kind of growth in this category?
Let's put it this way, that if we see opportunities for market share gains, because I don't see the category growing at any hugely significant pace, but it's such a large category that the potential for growth through market share gains is immense. And if we have the right levers in place, and if we are able to find the right levers, then definitely we'll invest because it is a high margin and, like I said, a category where we have huge upsides in terms of market share growth. So we'll take it as it comes. It won't really be the most focused category for us. Those belong to the more next-gen categories in consumer healthcare, et cetera, et cetera. But there are huge opportunities in hair oils which we'll seek to exploit.
Sure, and just related to this market share gain in volume terms in Amla, is this the first time in a few years that actually market shares has ticked up in volume terms, and any specific actions that you've taken to kind of help this happen?
Well, we did see sharp deceleration in Amla market shares around 2 to 3 years ago. Since then, they've been largely holding and the decline, if any, has been marginal. So yes, for the last 2 years or so, we've seen flattish kind of market shares, which are now trending up. But they did trend down, like I said, say 2 3 years ago. So we still have a lot of catching up to do. And I think we won't just look at Amla in isolation. We look at the Amla family of oils, which includes Sarso and Brahmi. And with that, I think the triumvirate can really take up shares very significantly. Now, how much of that growth will come from Amla and how much from the satellite oils, very hard to say. But we do intend to play these oils as a single unified approach against our competitors.
Sure, thanks. And the last question is on shampoo. So last 4-5 quarters, you've seen very high growth. There was the relaunch of Vatika also. So as you lap up now those, relaunch quarters, do you get a sense that this brand is now kind of on a strong growth trajectory like you had with Red a few years back, or is this growth reflecting in market shares in the shampoo category?
Well, it's begun to reflect in market shares, even though not significantly. But having said that, we are a comparatively small player, 4 or 5 share in shampoos. So there is no limit to how much we can grow here, because even if you grow from 5 or 4, where we are currently, to say 6 or 7, it effectively means more than doubling of revenues. So I would not say that the base should worry us too much. We have 5.4% volume share. So the base should not be something which we should be too obsessed about. What is the potential? And the potential here is perhaps more than any other category. It's such a huge category. So like in hair oils, we'll play the market share game here and not get too concerned that we are sitting on a high base, because I don't think that's very material. That may be material in categories where we have like honey or Chyawanprash or, some others, but not here.
Okay. Thanks so much and all the best.
Thank you.
Thank you very much. As there are no further questions, I now hand the conference over to Ms. Gagan Ahluwalia for closing remarks. Over to you, ma'am.
Thank you. I thank all of you for your participation in this conference call. A webcast of this call and transcript will be available on our website. In case you have any further questions, we'll be happy to address them. Thank you once again and have a nice evening ahead.
Thank you very much, members of management.